Hello, 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 hello. Bien? Yeah? Bien? Okay. Yeah. All right. Welcome to another class here. Today's class is in English, okay? Everything's English, okay? So everybody knows English, all right. So when the class is over, you want to ask me a question in Spanish, that's fine, okay? All right, so today's class is about taxes, okay? I want to talk about taxes so you understand how it works. It's important as realtors you have a basic knowledge of how to look at a tax return and what to ask for. Very important, okay? Because you are the face with the customer when you're at their house, okay? So when you're at their house or they're meeting with you and they're showing you taxes, you know what you're looking at, so then you can send it over to us, so we can look at it for you and get you pre-approved, okay? So it's very important. So we're gonna go over that today. My name's Javier Infiesta, branch manager at Abosute Home Mortgage. If you guys don't know me, been with the company now 16 years, actually 17, keep going. And behind me is when he was much younger, a little older now.
Much younger.
And he gained a few pounds, he's in love. His name is Miguel Sagado, all right? You know what happens when you're in love, you gain weight, right? So, he's actually heavily in love, okay? All right. So now, I'm gonna go over basic stuff real quick, just a reminder, recap. So when we're dealing with tax returns, okay, and we're working with tax returns, we're obviously doing what's called full documentation income, government loans, okay? So government loans, there's 3 government entities, right? There's FHA, and then there's conventional, which is Fannie Mae, Freddie Mac, okay? 2 different entities, but they do conventional loans, okay? So Freddie Mac and Fannie, you see right there, Freddie Mac does 1-year taxes, okay? Not 2 years, but 1-year taxes. But, it's always a but, as long as the customer has owned his business 5 years, I can do 1-year taxes, okay? If not, I need 2 years. With FHA, it's always 2 years, okay? We need 2 years of tax returns. So we'll go over that here in a minute. These are government lenders and government loans, okay? And that's how they look at the income. Next page. So FHA, we'll go over it real quick. Credit score, just a reminder, 640 is a magic number for FHA. However, FHA really has no minimum credit score, okay? Let me explain that real quick. It's called DU, right? Everybody here know what DU is? Just to go over that again, what's DU? Anybody know? Desk underwriter, but what is it? What does it do? Just think of this. It's the Chat GPT for the government. Just so you guys know, AI has been around for many, many years, okay? The government's been using it. We just started using it a couple years ago, okay? So it's an AI system that they've been using, that they run the customer's name, customer's background, and they know everything about that customer, okay? So that's what they do called DU approval, okay? If I don't have a DU approval, I can't do a loan. It's that simple, okay? And then with FHA, what happens is that when you do a 640 credit score, usually it always pops a DU approval. Anything below that, they're always gonna ask for something. They'll deny it, but they want something. Sometimes they'll approve it, just depends on the customer. I got a 620 credit score, I run DU and denies it, I put reserves in there. What's reserve? Anybody know what reserves is? Reserves is basically when I'm buying a house, let's say the house is $100,000. Well, let's not use that example because we don't have houses that cheap anymore. Say $400,000, you're buying a $400,000 house and you need $30,000 to buy this house, okay? Let's just say $30,000 with everything. The day I close on a house, I gotta send $30,000 to closing, right? And when I send that money, I only have in my bank account $30,000, $20. And I send $30,000, how much money is left over? $20, right? Well, 99% of my customers, that's what happens, right? They send a $30,000, have $20 left over, okay? That means they have 0 reserves, okay? What FHA and conventional they like to see is that when I send the $30,000, you still have 3 payments, okay, in reserve left over. So if the mortgage payment is $3,000, what's 3,000 times 3? 9. So they want to see that when I send $30,000 the day of closing, how much money is left over? 9,000, okay? That's 3 months reserves, okay? So FHA at 2 months reserves, probably pop out approval, sometimes 1 month, sometimes that needs 6 months, okay? That happens, and nothing we can do, okay? And it's the same with everybody. It doesn't matter what bank you use, okay? We all use the same DU system, okay? So that's why I put 640 there with a little asterisk, because 640, usually they don't ask for reserves, okay? 2-year employment history, always. 1 month bank statement, that's important. A lot of my competitors require 2 months bank statements always. We don't, we only ask for 1. Especially for the Latin customers, they believe in putting money in a shoebox, right? 1 month is all we look at, okay? Which is a good thing. First-time home buyer is always for FHA, except the asterisk there you see there is you can always buy another FHA loan of FHA property as long as you sell your existing property, okay? You can't have an FHA loan today and go buy another house with FHA again. No, you have to sell your house and get another one, okay? Primary residence, always. No such thing as an investment property for FHA, okay? And the minimum down payment is 3.5%. Even for a duplex, is 3.5% as well, okay? Just a real quick recap. Conventional, same thing. DU requirement. DU has no minimum credit scores for conventional now. They got rid of it. But guess what? They still look at it, right? So 680 is usually the number we look at to pop the DU approval. But sometimes I've seen where 700 credit scores are not getting DU approval. Recently, I had a 720 customer, they didn't get approved, okay? No matter what we did, all right? They didn't like it. Whatever it was, they didn't like them. So what we see now is with conventional, all we did was take him FHA to buy the house. But what we see nowadays is that conventional, they like multiple borrowers. So if I run one, let's just say husband and wife, I run the husband makes all the money, I run it and I get denied, they won't approve it. The wife makes $1,000 a year, right? She's self-employed, cleaning houses, doesn't make any money, that's why I didn't put her on the loan. But I add the wife, even though she has very little income. Sometimes I even add the wife with no income, as long as she has good credit. And I put on the application. I get DU approval. Sorry? DTI? Yeah, DTI matters, absolutely. So DTI, for example, and that's going back to FHA real quick. Go back quick a second. Answer your question, good question. So FHA also, if you're a low credit score, below 640, I'll give you another example. You're a 580, okay? But your debt to income ratio, what you make and what your debts are very low. And what's low? 35%, 40% or less, okay? So if you're 35, 31%, DU probably gonna approve it because you have good income to what you pay. You just have bad credit scores for whatever reason, okay? They look at stuff like that. Also reserves, like I mentioned to you before, or your down payment. So I had a guy with a 530 credit score that we just closed, okay? His credit dropped from 640 to 530 because in the process of buying his house, he decided not to pay his car payment. Okay, he went 30 days late, his credit scores dropped, okay? So when that happens, deal's dead, right? But guess what? We were able to get DU approval because he was putting 15% down payment, okay? So if he put 10% down payment, sometimes the credit score doesn't matter, okay? So an FHA buyer, if they have a good down payment, have crappy credit scores, we'll run DU to see if it approves it, okay? Remember, this government's very common sense, right? Think if you were lending the money to somebody. What do I care if the credit scores are lower if the income is good and they have a strong down payment, right? So they look at stuff like that. They want to see that, okay? That you have money. Remember, you're buying a house. What matters? Money.
Funds.
You gotta have money, okay? That's an important thing. All right, good, keep going. Okay, so now going back to conventional real quick, same thing. DTI is good, they'll look at it, but they like multiple buyers. They love to see more than one person on the loan, okay? So they see like 2 buyers, 3 buyers, credit score doesn't matter. I had one the other day get approved with a 640 credit score, conventional, because I had 3 buyers on it, okay? So that happens, which is a good thing. So we know the tricks. That's why it's important to work with great lenders that know how to manipulate the system a little bit, right? How to teach AI what to do, right? As I should say, all right? Okay, so 2 months bank statements are conventional. They look at primary residence, same thing. They can do investment too, but it's a different animal. And then 5% down payment for 2 to 4 unit properties. Obviously, it's a big thing right now. Keep going. All right, so now let's break it down. Let's go to taxes. So this is, you gotta write this down. You can write it down, take notes, okay? Very important you know this. I'm gonna break it down for you, okay? What is a 1040? Everybody look up there, 1040, right? 1040 is your personal tax return, okay? Everyone, let me repeat this again, everyone has to file a personal tax return, okay? Everyone, I'm gonna repeat that again. Everyone has to file a personal tax return, okay? So when a customer tells you, no, I file a business return. No, you file a personal tax return, okay? And you can file a business tax return, okay? Let's make sure that everybody understands everyone has to file a personal tax return, okay? All of you, me, everyone, even the IRS agent has to file a personal tax return, okay? All right, so everyone has a 1040, okay? So when you have a customer in front of you and we talk about taxes, ask them for their 1040. Everyone has one, okay? Get a copy of it, let's look at it. So if you look at the first part, the top part there, you'll see where it starts with, first thing you see up top, number 1A, total amount from W-2s. If you see a number there, what does it mean? He's a W-2 borrower, okay? So now he knows he's not self-employed. Or maybe he has a W-2 and he has self-employment income, okay? But I'm gonna show you that here in a second. The minute you see a return and you see a number there, get excited, we have a W-2 guy, right? It's a good thing, okay? If you see line number 1A, anything greater than $90,000, what do you have? You now have one good thing. You have somebody with money, okay? If it says 40,000 there, what does that mean? We have no money, okay? If you see $18,000 there, what does it mean? You have no money, okay? We need how much? 90 plus, maybe 80, maybe, you know, for $300,000 house, we need 90,000 plus, okay? That's the first thing you're looking at, okay? Now, what else are you gonna see? Did you cut it off there, Miguel? You have that page I can see a little better?
Yeah, it was a little tough, but I have the Schedule C on a different slide.
All right, so on number like 5, you'll see their Social Security. You don't see it there now, but you'll see Social Security income. If you see Social Security income, that's a good thing. We can use that, okay? So let's just say you have someone that receives Social Security income and they also work. I can use that income, okay? But that tells you everything there, all right? Next page. All right, so now we're gonna go over Schedule C, okay? What's a Schedule C? What's a Schedule C? Whoever has that, you guys can turn it off for me? Okay, no problem. So what's a Schedule C? All right, let's go over that real quick, okay? You have different types of self-employment, okay? Now we're gonna go over self-employment, okay? So the first most common self-employment, like a lot of you guys here, you receive what's called a 1099, right? So they give you a 1099, paper used, but they give you a 1099, and then you take the 1099 to your accountant and say, here's my income for the year, prepare my taxes, right? And then your accountant says, okay, what expenses did you have, right? And start writing all the expenses and remove your, all the expenses from your income. So your Schedule Cs are very popular for you guys, realtors, truck drivers, plumbers, electricians, could be a lot of things, okay? Hairstylists, nail technician. There's a lot of people that are what that's called sole proprietors, okay? They don't have a company, they don't have a corporation. They just are self-employed and they file taxes for themselves, and it's called sole proprietor, okay? So Schedule C is for sole proprietors, okay? That's one type of self-employment person, okay? Next, you have what's called an S Corp, okay? The next thing is gonna be an S Corp. What's an S Corp? You now open a business, okay? So let's just say, for example, I'll give you an example. Use you guys as an example, okay? So it makes sense. What is your name? Suli. So Suli is a realtor. Last year, she filed as a sole proprietor, Schedule C. Let's say she made $1 million, right? That'd be great, right? But now she's paying a lot of taxes on that $1 million. What does she decide to do? An accountant told her, you need to open a corporation for yourself. Every realtor should have an S Corp. If you don't, when you leave here today, go open an S Corp for next year, okay? You should have an S Corp. You pay a lot less taxes on S Corp, okay? So now what you do is, Suli is now gonna be Suli Gonzalez LLC, okay? You can open your own corporation with your name. That's it, you're good, okay? So that way all your income goes where? To your business account, okay? You pay a lot less taxes as an S Corp than you do as a Schedule C. It's literally double, okay? Just so you guys understand that, all right? And you can, again, I'm not a tax preparer. You can speak to your licensed tax attorney, whatever, but I'm telling you, it's almost double, all right? So now, going back quick. So you have a Schedule C, sole proprietor. The other is an S Corp, okay? You have an S Corp tax return, okay? Then there's another type of tax return. It's called a C Corp, okay? C Corp is for people that have, like explained to you, it's really not a great corporation to open, but it's more for the companies of truck drivers that have a corporation or a roofing company or a big, massive, say Best Buy, for example, things like that, right, are more C Corps, okay? So a C Corp does not flow to your personal return, okay? A S Corp goes to your personal return. So if I have an S Corp, okay, I'm gonna have to claim on my personal return and acknowledge the government that I have an S corporation and here's my income, okay? When it comes to a C Corp, I could be the owner of the C Corp. The bylaw says I'm the owner. I don't have to claim that income on my personal return. Why is that important? Because that is a difference of you guys having a closing or not having a closing. Always ask the consumers, do you file one or do you file two taxes? They know. Believe me, they know, okay? A lot of times they give you the personal return and say, oh, my corporate's in there. Are you sure you didn't file a C Corp? Ask. Why? Because there's income there. I can tell you many times that I have a customer bring me his personal return, Schedule C income from his company or her company. And I see it, Schedule C, and it says, let's say Absolute LLC or Absolute C Corp. And I ask him, who owns that Absolute? Oh, I own it. And I look it up on Sunbiz, and I see that he owns it. Okay, do you have taxes for this company? Oh, I think I do. Can you please find it? And then when I get those returns, it's more income. One time I had a guy that I was only pre-approval for $200,000, and then the corporation was making $300,000 net a year. All of a sudden, the approval went from $200,000 to $1 million. Big difference, huh? Right? So that's where it's important to ask for those things, okay? And make sure you ask. That's why I teach you guys to ask these questions, because the more I teach you, the more deals we can have for everybody, right? Make sense? All right, so the C Corp does not flow, okay, to the personals. You have to ask, okay? The next one is called a 1065, which is a partnership one. So let's say that me and Miguel owned Best Buy together, okay? We file a 1065, okay? We could file 1065 and we're partners, okay? We have multiple partners, like more than two, usually 2, 3, or 4, or 5 partners, they file 1065. When it's 2 people, they still do an S Corp, okay? But this also flows to the personal. So you'll see that on the personal return, okay? Not to confuse you, real simple, the purpose of me showing you this is to ask more than once, ask 3 times to the customer, I need your personal and your business return. Because 90% of them always tell me, I don't have a business. I don't have a business return. No, yes, you do. Get it to me. Let me see it, okay? Because a lot of times it's just customers just being lazy too, okay? All right? Next page. So now I'm going to break down for you what we look at on the Schedule C, okay? Everybody can see the board there? So when you look for a Schedule C, always when you get taxes, you get all these pages from the customer, just go right to the Schedule C, okay? The top says name of proprietor. Remember I said you're sole proprietor, right? So name of the proprietor, right? Guillermo London, okay? He's a realtor. It'll say Guillermo London, name of proprietor. Principal business, Partnership Realty, right? 1099 came from Partnership Realty, right? And then C will be the address, or sorry, E will be the address, okay? That's just basic information. Obviously, we're gonna look at that. It's very important to make sure that when I'm looking at 2 years taxes, that if he's a realtor in 2024, that in 2023, where it says business name or principal business or profession, it says realtor also, okay? Because if 2024 said realtor, but in 2023 it said insurance agent, can I use the income?
No.
I cannot use the income. I need 2 years, right, of working the same profession, all right? That's why when I see that, I always look at to make sure the profession is the same, okay? Or same line of work, right? If I did insurance agent selling insurance sales, and now I'm doing life insurance, is it the same kind of work? No. Yes, it is. It's still insurance, okay? Same line of work, because it's still insurance sales, okay? But if I am a realtor and then now become a life insurance salesperson, same kind of work? No, right? Different, okay? Completely different. So it's got to make sense, right? Got to make sense, okay? So now, keep going. Number 1, gross receipts, sales. That's the total that you receive on your 1099, okay? Schedule C matches 1099s, usually, okay? I'll go over that in a minute. So the gross income, that's what all the customers tell me when they call me, oh, I made $100,000 last year. And they'll say 100,000 on, they're all excited because the 1099 says I made $100,000. And then line number 1 says $100,000, right? Can I use that income? Oop, that's the gross, right? So now the accountant starts putting expenses. Number 8, advertising, he puts 5,000. Commission or contact labor, whatever, car expenses, he puts 15,000. Insurance for the car, 3,000, whatever. Travel and car and cell phone, supplies. You name it, supplies, and they make up all kind of different things, right? And they put all the total there, okay? We use line number 31, okay? You have 31 there, you don't see it there?
No, it's cut off.
Okay, cut it off, okay. So line 31, you don't see there, but line 30, 29, 30, kind of see what it is there? That's what we use. We use the bottom line, which is line number 31, okay? We take 31, the bottom, after all expenses, as the income, okay? But, you see number 13 right there? If you have a page there in front of you, if you use the paperwork I gave you, if you see number 13, we add back in 13, okay? So let's do an exercise real quick, okay? Is there numbers on that one? They're all blank, okay. So let's just say we have gross $100,000, right? Let's say after expenses, line 31, we have 42,000. Okay? Everybody with me so far? So line 31, I have 42,000, okay? Line 13, they have depreciation. What's depreciation? Anybody know? Depreciation is things like cars, equipment, for tools. Tools, a big one, okay? I've seen people like, I tell a story all the time. I had a guy that he sold tanning beds, right? His job was selling tanning beds, and he would go all over Florida and Georgia and South Carolina delivering tanning beds. And tanning beds are like, I didn't know this, but $15,000 for a tanning bed. Crazy, right? So he would sell these tanning beds to these, places, and he would always service them. And so his depreciation was $200,000. Crazy. Because he had what? He had all these tools and all these expenses from the tanning beds and driving all over the state, okay? So those are things that can happen, right? You could have $80,000 depreciation because of, the high cost of equipment and cars and whatever. So in this case, let's just say that you made 100,000 gross, you had 42,000 net, his depreciation was, say, $20,000. Okay? So now I have how much income? 40 net plus depreciation. What's my income now? 62,000. Okay? Remember, the bottom was at 40, but I add back depreciation. Okay? So now it's 40 plus what? Plus 20,000 depreciation. Okay? So now I have 60. With me so far? Okay. All right. No? All right. Let's do it over again. So number line 30, right? The bottom number was 42,000. That's the total. 31. You can't see it there. 31. You can't see it there because the screen blocks it up with 31. Yep. So go to Schedule C. You don't have it there. They don't have Schedule C on these pages. So you didn't print out Schedule C.
You didn't print it out?
Yes, you there? You don't print out? Okay. So Schedule C, line number 31 is what we use, the bottom net number. Okay?
42,000.
42,000. Okay? So you're going to write 42,000. Okay? 42,000. 42,000. 42. 42. Okay? How you say it in French?
In French, I don't know.
Okay. All right. Abosute. Okay. So 42,000, and then depreciation was 20,000, right?
Which number is depreciation?
13. See the big line I put there? 13, the arrow? 20,000. So write that down, 20,000. So you see 42 net, you see 20,000 depreciation. I add back that in, what do I have now, total income? What's my total income now? 62,000, okay? That's why depreciation is huge, okay? Say again?
Rental business, the properties are
We can use that, but that calculation is different. It's a different animal, okay? Because it's real estate income. That's different, okay? This is based on Schedule C income. So that's on a Schedule E. Schedule E is for rental income, okay? That's separate. It's different. Different form, okay? All right. Everybody with me so far? Question?
The 62,000.
Yes.
What you put it on? What is
I just calculate them aside, okay? That's the income that I use, okay? So I'm showing you a customer came to you and you see he has 42,000 on line 31. You see that he has 20,000 on line 13. So far, I have 2,000 on income. Right. I'm not done yet. I can add more income. Okay? So far, everybody with me so far? All right. Next page. Then I can also use the mileage, line 44, where it says business mileage. So for example, my guy who travels all over the state delivering tanning beds, he has, on this section, he has 68,000 miles, let's just say. Okay, you know what? Make it simple, make it easier. Let's say 40,000 miles, okay? 40,000, okay? Calculator. Now you have to do math now. You don't have the page there? No. Okay, sorry.
Both pages.
Didn't give you the page, I'm sorry. I'll get you one in a minute, okay? No tienen Schedule C, la gente Schedule C. ¿Te quedó? Okay. Yeah. Sí, no tienen. It's okay. Mucha gente, aquí tampoco. Dos páginas más. Yeah. Okay. So, cuando tú ves aquí ahora, si quieres, mira la pantalla. Está arriba la pantalla igual, okay? So, look at the screen real quick. So, where it says business, right? And then right there, we just said it's what? How many miles?
40,000.
All right, so 40,000 miles. Now you have to calculate. We use 27 cents a mile, okay? So you're gonna take 40,000 times 27 cents. What is it?
10,800.
That's $10,800. So now my total income for 2024 is 42,000 net profit, line 31, depreciation 20,000, and 10,800 for miles. So now I have how much?
72,000.
Okay? I have $72,800 in income. And he paid taxes on how much? He only paid taxes on
42,000.
42,000. Okay?
just one time.
That year.
All right.
Okay. So I use 2 years though. Okay?
But you cannot use the next year that depreciation.
I can. If it's there. Of course I can.
So, the 40,000 would be divided or multiplied for 20?
No, you multiply by 27 cents.
By 0.27.
0.27.
0.27.
Right. So you take 40 times 0.27 equals, that's your income.
And the money that you use, the bottom line, after all the depreciation, so that then you know how much you can count on?
Yes. It's the bottom line, and we add back depreciation, and we back mileage. Okay? So that's why it's important. A lot of times people don't see that. Mileage is huge. I see people with 80,000 miles. 80,000 miles is not 20,000 income. You know what I mean? And a lot of banks, by the way, do not accept mileage. Even though it's a guideline, they don't take it. Like Bank of America doesn't take it. Wells won't take that. We do. Okay? Just to give you an example.
It's
That
a
can make a
good
big
thing for
difference.
you guys to have this knowledge too, because a lot of times, you know, your customers will
Everybody keep the voices out for a minute.
1 second, yeah. It's good information for you guys to know because because a lot of times borrowers will have tax preparers that don't know what they're doing, and we'll see all the time truck drivers who drive thousands and thousands of miles a year with no business miles on there. So it's something that you can, you know, communicate to your buyers that help them pick the right people to prepare the taxes.
Okay. All right, listen up real quick. Got too many people talking at one time. All right, so business mileage, real important. On the business mileage, this could be 40,000, this could be 80,000, there's no limit, okay? If they drove 200,000 miles, right? We're gonna use that, whatever they count and put on here, okay? Remember, we are not the IRS, okay? We are a bank, we're lenders. We just follow the rules, right? If the rules, they placed this, they did this, we're gonna use it, okay?
Even if the IRS give you a credit for less money, the bank is going to give you the credit for...
Yes, yes, we're gonna use this formula,
Okay.
okay? This is our formula, not the IRS formula,
Yeah.
bank formula, okay? No, let me rephrase that. This is the government formula for lending, okay? All right? And what's funny is the same government does a different formula to charge you, right? Whatever, it's their problem. But this is our formula to do a loan, okay? Make sense? Okay? Now, this is 2024. 2023, okay? Let's just say that my income, all this was pretty much the same. Let's just say that after I did all the math, I made 70,000 in 2023, okay? After all the math. I'm gonna take both years, 142,800, right? And the 142,800 divided by 24 months is my income,
5950.
which is 5950. Okay? That's my income. That's how we do it. All right? It's that simple. Okay? Now, can I buy anything with 5950 income today? No. You can't. Okay? You need to make about 7,000 a month minimum. Okay? So, but if my customer made 5950 and his wife made 20,000 a year, working at Bodegón, for example, right, as a waitress, now I have how much income? I have 8,000 a month. 8,000 a month, we're buying a house for sure. Okay, make sense? All right. So this guy went to Bank of America and got denied because he only made $40,000 a year in income, but he makes how much for real? 70,000. Because a lot of banks do not take depreciation or mileage. Okay, a lot of banks don't, right? Because that is a formula that they can either accept or not accept. Because remember, banks have their own layered guidelines. The government says, I'll buy this, but they have their own guidelines for lending because at the end of the day, when people don't pay, the government says, hey, they didn't pay, the loan's yours again. Here you go. These people are scumbags, I don't want it. That's what they do, okay? And then the bank, the lender, has to buy that loan back. And now they're stuck with that loan, right? A bad loan. That's unfortunately happens for us. You guys close a deal, you move on. They don't pay their mortgage up to 3 years, we have to buy the loan back. Imagine that, 3 years, okay? It's pretty aggressive, right? And we make a quarter of what you guys make on a transaction, right? So to give you an example of the actual difference between a lender and a bank and a realtor, right? So we always gotta make sure that these people can make their payments, right? It's important, okay? I have on my desk right now 4 customers, right now 4 people that haven't paid their mortgage in the last 6 months. Today, this morning, I walked in 4. I got to figure out what we're going to do with that, you know? It sucks, you know? It's not good. So, any questions with that part? No? All right, next page. All right, so now we're going to go over the 1120, okay? You need an eraser?
No, I didn't find the eraser.
Find one in the back. All right. So same thing with 1120. Remember, we went over the Schedule C? Same thing. It's just on a different paper, okay? Top part is the name of the company. It tells you the date. Look at E, number E, date incorporated, the date the corporation opened. If the date of that corporation is greater than 5 years, does that matter to me? Yes or no?
No.
Of course it matters.
More than 5 years?
Yes.
More than 5.
More than 5 years. Because now, excuse me, because now with 5 years, I can now ignore the previous year. I can maybe use only 1 year taxes, right? 1 year taxes is huge, right?
But for us, looking out for you, it would be great, so that means that we can bring it to you.
Correct, correct. So you want to always look at that to see if it's been 5 years or more. Yeah, because if it's 5 years or more and they have good credit score, then now I'm doing a conventional loan with 1 year taxes. It's much easier than doing 2 year average, okay? Always, okay? So we always look for 5 years, okay? All right. So now, line number 1, same thing. The difference between an S Corp and a Schedule C is that you, as a Schedule C person, you get a 1099 from, let's say, partnership that says you made $100,000. But then you also, I don't know, say you manage properties as a property manager, okay, your customers, and they paid you cash to, to basically manage properties for them, or they gave you Zelle payments, okay? And you now can claim that income. You don't have a 1099 for that, but you can claim that income in your Schedule C, okay? You can say, okay, I made $20,000 managing properties. Here's $20,000 I made extra that you can add to your Schedule C, okay? That's why Schedule C income, a lot of times, the consumer can put whatever, right? Because the government's gonna take whatever you claim, no problem, with no proof, okay? That's fine. But with an S Corp, it's different. An S Corp, the income they put on line 1C is the income that matches dollar for dollar their bank statements for the year. Follow me? So they're gonna take 12 months of the business bank statements, take all the deposits, that's total income they made, that company made, and it goes on line 1A, okay? You can't add more or less. It has to be what you put on your bank statements, okay? It's gotta match dollar for dollar, okay? And then goes all the expenses. Obviously, the bank statements show the expenses, right? So the accountant puts salaries, taxes and licenses, fees, interest, rents, advertising, whatever, all the expenses, okay? Same thing, line 22 is the net. That's the amount that we're gonna use that flows to the personal return, and they get what's called the K1, okay? K1 shows the ownership percentage and what you've made, what the company paid you, what you earned on that business, okay? We're gonna take the K1, total income, the net there, and do the exact same thing. We're gonna add depreciation as well, okay? Depreciation for a corporation is huge, right? Because now it could be a big number, okay? Sometimes a corporation can have multiple cars, I'll give you an example. Let's say that we're doing a loan for someone that owns Florida Crystals, okay? Which we've done it. And Florida Crystals, they bring in, I don't know, $60 million as a company a year, right? But the depreciation is almost like $1 million because they have like 40 cars for their salespeople, right? So that's a big number, you follow me? So that's why it's important to understand depreciation is your best friend, okay? It's our best friend, I should say, right? So it's important to know how that works, okay? So we add back depreciation. Go back. Go to K1. So that's the K1, okay? That is the version of a W-2 for a owner of a company, okay? So let's just say me and Guillermo own a company together, okay? I'm gonna pick on Guillermo a little bit. So me and Guillermo own a company together, and it's called Infiesta Corporation, not Guillermo Corporation, but it's Infiesta Corporation, right? But Guillermo's 50% owner and I'm 50% owner, right? What happens is that the company made $100,000, Guillermo's gonna get his K1 saying that he made $50,000. It'll be on line 1, 50,000, right? Because it's the net number split. And then it's gonna show G on the far bottom left, his ownership percentage. He's 50% owner. So my K1's gonna say the exact same thing, 50% owner, 50,000 income. Guillermo's gonna show 50% owner, 50,000 in income. Now, it's important to understand that can I use 100,000 of the corporation income? No, because the loan is only for Guillermo. So I can only use Guillermo's income portion of the business, which is how much? 50,000, okay? That's an important thing to know, okay? So that's the difference, that's how we know. The K1s tell me. No, it's what your accountant, when your accountant put together your corporation, he has to file, okay, articles of your corporation and puts who the percentage of owners are. And then that ownership percentage is what he files his tax at the end of the year. That's what we have to use.
But the articles are public records?
Yeah, 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 you can see that. Yep, it's on there. And then also keep in mind too that, but you can also do a operating agreement, okay? Some people do operating agreements. And if your operating agreement shows that you're 90% owner and I'm 10% owner, and the accountant puts on here 90%, 10%, we're gonna use that, okay? Because we're going to do whatever the accountant puts, you know what I mean, at the end of the day, okay? But the operating agreement can be changed. You can always change that, okay? It's called the operating agreement inside of an actual S Corp. On a C Corp is the bylaws. They use bylaws. The bylaws tells you who owns what, okay? Good question. All right, so now we're 50% owners. I can use his $50,000 in income, okay? Next page. Now, the difference between a Schedule C and a S Corp, now if they have travel or entertainment income that they are trying to reduce from their income, I got to hit that and remove it from their income, okay? So now the net was, say, $100,000, but they put $10,000 in travel and entertainment expenses. Now it's no longer $50,000. Now I got to go half of that $10,000. Now it's only $45,000 I can use for income, okay? We always got to remove that. Keep going. Next page. Okay. Oh, okay. So real quick before we go over that, so everybody understand that, going back quick. So the Schedule C, the S Corp, and the C Corp, we always get to use the net income plus depreciation, okay? Except on a Schedule C, we always also going to use the business miles. There's no business miles on an S Corp, okay? Only on a Schedule C, all right? So that's how we take the income. And it's over 2 years average, or 1 year if they've been in business for 5 years or more, okay? So now let's use another exercise, okay? You have an eraser again there? Might need it. So let's just go with, let's use somebody else. I already picked on Guillermo too much. We'll use Wilson. All right, Wilson. So Wilson, you can exaggerate if you like. How much money did you make last year in 1099? Do you remember? 1 million? 1 million? All right. All right, so Schedule C. All right. So your Schedule C net profit, right, was $500,000. Was your gross, and then your net after expenses, let's say, was $100,000 on line 31, right? Okay. Depreciation was, say, $20,000 depreciation, okay? Line 13, right? And miles, he had 10,000 miles. So we had 2,700 on miles, okay? This is 2024, let's call it, okay? So what's my total income? $122,700 is my income for 24, okay? In 23, he made 90,000. I got this for a minute. Line 31. He had 10,000 in business miles. Line 13. This is 23. And mileage-wise, he had, say, 20,000. So it was 20,000 times 27 cents a mile. What is that? 40. Give me a number quick. Okay. And business miles. All right, so add this up for me. So 10, what is that? I got it here. 10, 110, 800. So now calculate 122,700 plus 110,800. So now I'm going to take these two numbers here, 233, how much? 500 divided by how much?
24.
24. What's my monthly income? So my total income is $9,741 a month, okay? 2-year average.
So if you have the company for more than 5 years, we use only the first.
That's right. So big difference, right? Take 122,700 divided by 12. What do I have?
10,000.
How much?
10,000.
So watch this. Look at the bottom. My income is $9,741 a month on a 2-year average. It's $10,225 on a 1-year average. Okay? What does that do for me? I'm gonna show you. Give me my phone real quick. So I'm gonna show you real quick. It's just to give you an idea. Say we have no expenses, no cars, just house only, right? Just to give you an idea. Okay? So if I make $9,741, and we'll use FHA, okay? That means I can have a mortgage payment of $4,500 a month, okay? So $4,500 a month mortgage payment with FHA today, let's give you an example, let's do it together. Taxes today, let's say a house of about $500,000. Tax will be what? $5,000 a year, right? Just $5,000 a year, call it. Insurance, call it $4,000 a year. Mortgage insurance, we'll call it $200 a month. No HOA. So my P&I can be $3,500 a month, right? So $3,500 a month P&I. Say a rate at 6%. So I could buy a house for $585, okay? So my pre-approval is $585 to $600,000, somewhere around there, for somebody that makes $97.41, okay? So here I'm at how much? $585 to $600 pre-approval, okay? But now at $10,225, now that pre-approval jumps up to, that's $4,800 that I can pay per month, okay? That's $300 more per month, okay, that I can have in payment, right? So all of a sudden now, hold on. I'm gonna add $300 to that. So now, I can buy a house from $625 to $630, okay? It's a difference, right? Okay, it's a difference, right? Okay. So when we do pre-approvals, I'm always gonna send out the best case scenario, right? Always, okay? We'll send out the best pre-approval and you go look for houses. And then obviously when you have a house in mind, they like it, what do you always do? You text me the address, here, the name, confirm, numbers work, right? Before we put a contract in. And we do the numbers, make sure it works, and we're good, okay? If it doesn't work, what do I tell you? It doesn't work. Keep looking, right? Simple, okay? Because this is black and white. When you're self-employed, it's black and white. There's no gray area, okay?
So more or less, if person $10,000 a month, the mortgage can be more than $5,000, about half.
That's right. About that, yep. Yep. It's 47% with FHA.
47?
Yeah.
Sometimes maximum.
Maximum for the mortgage payment, the total debts is 57%. Conventional total debts and mortgage payment can exceed 45%. Sometimes they go to 50, depends on the customer's credit score. But yeah, okay? FHA is more aggressive when it comes to that. But that makes sense, everybody?
Can you explain after the total 110,000?
Yeah, that was so this was 2023. Okay? So I took 2024, he made 122,700 between all the sources of income that I can use, right? And to break it down again, I take the net number, line 31, I add back in depreciation, and I calculate the mileage, okay, at 27 cents a mile. That gives you my total number for the year, 122,700, okay? Now, if 2023 was more than this, what happens? I can't average it. Now I gotta ignore 23 and use the most recent year, okay? But in this case, I did the same math. I did 90,000 net, 10,000 depreciation, mileage was 10,800. My total for the year is how much? 110,800. So it's less than 24, right? So I'm improving. They always want to see you're improving, not getting worse, okay? So you're improving, I averaged the 2 years. We took 122,700 plus 110,800 for a total of 233,500. And then my total 233,500 divided by how many months? 24, because it's a 2-year average, okay? Because he's got a 700 credit score and his business open 5 years, I said, okay, we could ignore 23, right? And we can now use what? 1 year average, which is 10,225, okay? But now a conventional loan, okay? When it comes to DTI, debt to income ratio, yes. Yes, they're more aggressive when it comes to, sorry? No, for everything. Because remember, FHA is 57% debt to income ratio, total debts. Conventional is 45%. So your difference in approval can be $50,000 to $100,000, okay? Between FHA and conventional, okay? The big difference. All right, any questions? Sorry?
You use only 1 year? How do you do it?
Say again, I'm sorry, question?
If you don't improve.
Yes, so the question was, if I don't improve, let's go backwards. say that this was 23 and this is 24, right? So then he made more money in 23 than 24. As long as it's not more than 25% declining, because it's 25% or more, then he's done, okay? But it's less than 25%, then I can go ahead and ignore the bad one, right? The most recent one, I'm sorry, the good year. I use the most recent year, okay? So I would use this one only. Make sense?
Okay.
Because I went from making 124 to 110, I'm not gonna average it. I'm gonna use 110. 25%. Yep. So let's just say he made 122 in 2024, I'm sorry, 2023, backwards, right? And then in 2024, he made 90,000, right? Done, dead. Yep, can't do it, okay? So it can be more than 25% declining income, all right? But it makes sense, right? If you lent the money, always remember this. If you lent the money, would you do that? No, you'd probably be worse, right? Correct. Correct. And you can't. Then you'll be in court, 3 months later, and the guy's telling you I can't make a mortgage payment, and you're in court now trying to explain to the judge that why you did that loan for them. That happens. Let me tell you, I've been in court many times. All right. In 2008, I was in court a lot. My whole week was court dates, literally. It was the worst. All right. Any questions on the income? No? Okay. So why we share this with you guys, right, is to know what we look at, all right? So now you know what we look at. So now I'm going to teach you what it is that when we're looking at this stuff, why it matters, okay? That's the next step now, right? Okay. So now, customer comes to me, okay? Give me the thing. Okay. So we're going to keep it simple, okay? Now we're into the new year. Can you imagine? It's 2026 already, right? Jesus. I can't believe it. Just yesterday, it was COVID. Right? So now, this is 24 taxes. Right? And you're getting phone calls from customers. Hey, I'm ready to buy, I'm ready to buy, I'm ready to buy, I'm ready to buy. Great. Okay? So the first thing you want to tell a customer is, send me your 2024 taxes. Okay? What's the first thing you want to tell a consumer? You can tell a consumer, make sure when you file your taxes, right? Before you file taxes, before you file and send to the IRS, send me the draft copy so that I can have my lender review it for you, right? And make sure also let them know that your income, make sure your accountant doesn't try to kill you, right? And make your income less. You got to claim at least the same or more, right? Make sense? That's the first step, okay? Make sure they claim the same or more, okay? And then when you get a copy of that, send it to us, and then we'll let you know what their approval is at that time, okay? And many times we can see things that the accountant's doing that may be, for example, like double dipping expenses. Why does he have truck and car expenses and also have depreciation? Doesn't make any sense, right? Maybe he can raise the depreciation, get rid of the truck expenses. You know what I mean? That's more income for you, okay? Stuff like that we can see. You'd be surprised how bad, and I'm telling you, 75% of the tax preparers that I see out there are horrendous, okay? And don't know what they're doing, okay? Now you have the certified public accountants that have been doing this for 20 years that know what they're doing, they're good. But what happens? No one wants to pay, right? Everybody wants to pay $200 to get their taxes done, I pay $3,000 to get my taxes done. It's a difference, right? Because why? Because I want to make sure my taxes get done right, okay? Everything good what? Costs what? Costs money, right? A t-shirt from Walmart is completely different than a t-shirt from Macy's. Am I right or wrong with that statement? Yes, no? Okay, same thing. You guys, right? Your value. Why is it important to hire a realtor? You know why. I don't have to explain it to you. Same thing, okay? So that's why it's good to make sure you guys know that. So that way when they're coming to you and you see, I don't know if I should say this, but
Truck driver with
yeah.
no business miles.
Yeah, something like that, A truck driver with no business mileage, no depreciation, and he's a truck driver driving all over the country. What? Doesn't make any sense, okay? Stuff like that. All right? So make sure that online, if you have any questions about the class today, or if you want more information, or if you have a customer that you want to review your taxes, give us a call. Our number is 561-386-8357. Again, 561-386-8357. That's my number. Call me anytime. If I don't answer you, Send me a text. I will get back to you always same day. I do receive a lot of phone calls. I try to get to all of them, but I can't. Obviously, I'm a human being. One day I'm going to hire a robot. I will have a robot soon, okay? And will answer every call for me. For real. It's going to happen by hopefully March or April. You'll see me walking with my robot, okay? I can't wait. All right. Online, we're good. Thank you so much online. Cierra ahí. Thank you.